Ladies and gentlemen, welcome to the Investor's Journey podcast. I'm your host, Josh Klein, and with me today, I have Avi Kozlowski, Managing Director of Greystone, on one of the top producing teams in the country, responsible for over 100 transactions, multiple billions of dollars across multiple regions in the country. Avi is a fantastic investor, a fantastic lender, and he knows a tremendous amount about the industry. Welcome, Avi.
Thank you very much. It's good to be here.
Yeah, it's great to have you. So, just to start off, I'd love to really talk about your background. How did you end up in the real estate field? Where do you come from? And what your journey is?
I was a finance and accounting major at the University of Maryland. I was pretty set in the consulting track, and then I got connected to a guy, Dan Sachs, who was a salesman originator at Greystone at the time. He had been growing tremendously and needed some help. Went out for drinks, talked to me about the industry, and single-handedly over the course of the night, we went out for like 6 hours that night. And by the end of it, he'd offered me a job and was really trying to push me there. I did some research a few months later, had a legitimate offer, and decided to jump in. I had my real estate salesperson's license. I knew I was interested in the industry, but I was really going down the consulting route. And then this kind of showed up at my door, and I haven't turned back since.
Wow, wow. So you've been in the industry for, almost 10 years at this point, right? I'd say 8 to 10 years.
Yeah.
So obviously the market has changed drastically over those years. So through your experience in say year 1 and 2 versus what you're experiencing now as a more seasoned professional, as a managing director, and probably more active in the process, how have things changed in your outlook on the industry?
Yeah, it's a great question. They've definitely changed a lot. I think the biggest thing is when I first started in this industry, right? It was right after kind of the last recession. Things were just starting to move in that upwards trajectory, and they continued to do that up until COVID, and then even during COVID, and up until interest rates started rising. So there was this real, you get in and you just make money. It was that quick money, the syndicated 2 years, and then you cash out your entire equity and get into your promote. And that was something that all of my investors have done really successfully over the last 8 years, and that's shifted now. You're not seeing deals that are strong enough out there, and you're not seeing appreciation to the same extent. In fact, you're kind of seeing the opposite. You're seeing cap rates kind of jump up. You're seeing values depreciate for the first time in a while. And so, real estate's going back to that, 20, 30, 40, 50 years ago kind of trend where you have to hold the asset for a little bit, and it's not this short-term gain. You really need to operate well, keep conditions of property strong, and, wait for that longer term return.
hmm So are you seeing a lot of players that have been in the industry for many years kind of get priced out or almost step away from the industry, given that the easy money has now been taken and is long gone?
I'm definitely seeing it's harder to raise money. I think a lot of people in the last few years have been burned on these bridge loans. People were forecasting 5% rates as the ultimate highs, maybe 6% if you were on a floating rate. I mean, some of them got capped, some of them didn't, but those cap costs you're seeing, just grow to outrageous amounts where the escrows to buy your next cap in the future is eating in the entire cash flows of properties. And so we're definitely seeing some investors struggle and just not able to get out of their debt, or if they are, they're cash neutral or slight cash in deals just to keep the property and hope that over time they can make it back. We're seeing a lot of people take pref slugs to try to get to cash neutral. Definitely works for the short term, but at the same time, you're kind of just putting bad money on bad money to some extent, and markets could change. We've seen major appreciation in short periods of time, but these are definitely signs of weakness in the market, and things that we don't want to be seeing our investors doing.
Right. So you speak a lot about interest rates being a real challenge in this environment, and you say floating rate debt, the challenge of refinancing at a potentially much higher interest rate than you had initially anticipated. But there are also a handful of other challenges, I think, within the real estate market. Have you been noticing costs? I know people talk about insurance, taxes. Are there any other operational components that you've noticed just in the industry, maybe softening of just demand of rental growth? Have you seen other challenges outside of the typical just, higher interest rates is more challenging?
Yeah, 100%. I think insurance throughout the country is skyrocketing, especially in the coastal areas, and that's definitely been a huge challenge and something that people are still absorbing. Luckily, I don't think you've seen taxes grow too much. I don't know if that'll change or not over the next few years. But that's definitely something people are talking about. In general, yeah, R&M costs, just staff costs, everything's going up. Inflation's really been hitting the space, and luckily there was a lot of NOI growth at the beginning, to kind of counterbalance that, and you're seeing rents go up.
Hmm.
But the fear is that going to continue? And definitely you're seeing projections on these co-stars and Reese's that where we're giving you 3.5-4% rent growth in a lot of areas that are dropping to the twos, and all of a sudden, if your expenses are growing by 3-4%, your income's only growing by 1.5-2%. You might not be growing your NOI, you might be shrinking it. With
Hmm.
cap rates shrinking, that could be pretty bad for some of these properties.
Yeah, yeah. And so a lot of your experience, I know, is on the lending side. And I know you do have experience both as a passive investor and an active investor in some other real estate projects. So you speak a lot about the challenges that some of your clients are facing. What do you recommend for your own properties? Or if you were to kind of sit on the other side of the table, what would you do differently to hopefully prevent some of these challenges from coming to fruition?
Yeah, so it's a great question. There's like a network of people in the real estate industry where, right, insurance. I've had like 5 or 6 people reach out to me because they heard one guy in Columbus, Ohio, got an incredible insurance policy, and so they want to find out, like, who was that? How do I get that? And I think it's word of mouth. It's finding out, where are the best deals? Where are the right contractor, the new guy who just came into the market, who's a little bit cheaper, who's still able to give that service. I think that's going to be a huge component over the next few years. It's going to be shopping. Going back to that, it's a little less passive. It's a little more active. You may have to make some calls. You may have to talk to some people, but if you can really spend the time and get ahead of that stuff, there are opportunities to save. And
Hmm.
then, I do still think there's opportunities for rent growth. And again, I think management's going to become a lot more active than it is passive over the last few years. You kind of just let the management company do their thing. Um, but properties aren't necessarily running themselves as easily. If you want to maximize them now, you're going to really need to put some time in.
Yeah. So, and you speak about there are opportunities of rent growth, and just anecdotally, we've seen so many people kind of move south towards Florida that have really experienced a ton of rent growth. And I know Greystone, and you guys have done a number of transactions, over 100 transactions this past year, of which, like I mentioned, you have been directly involved with over 70. Where have you seen a lot of the operators gravitate towards? Are there certain regions, states, type of submarkets that you've noticed is where people are headed?
Yeah, I mean, we've seen people move all over the country, generally away from the New York, New Jersey, Pennsylvania, Delaware, Connecticut type areas, where I would say the majority of our deals were over the last 5 or 6 years, and it's shifted more, Florida, Georgia, and then we're seeing some decent opportunities in LA again, and I guess there's some bad debt fears for some of these properties, and so the operators that can really come in actively and clean up the properties and help kind of get them to their stabilized levels, they've been finding some pretty good cap rates.
Mhm.
We've seen a bunch in Virginia, some really good opportunities there. A ton in Ohio. A ton of people have been gravitating there just because you're getting really cheap price per door, and still a decent market with the city, with employment. And so the hope is over time that just continues to grow. Um, and we're seeing on the larger deals, we're actually seeing cap rates a little bit stronger, which just kind of mirrors the fact that it probably is harder to raise money right now. So once you get to the, 40, 50, $60 million equity raise, it prices out a lot of people. And so we're seeing,
Mhm.
6.5, sometimes even 7 caps on some of these larger assets that need a little bit of work, but you just get a little bit more capital if you really can raise it or have it yourself. And I'm not saying rates are going to necessarily go down as much as people think. That's a separate conversation. I think we're a little bit overstating the reductions, but they are going to drop. And at some point, you're going to be able to refi at a better rate. And so, getting a stable asset at a good cap rate, where we're back to the old real estate. You buy well, you buy a strong cap in a strong market, and you focus on your cash flows, and that's how you make money.
Mm-hmm. So for the viewers that are maybe not as involved in the industry, cap rates are a huge way in which you value a property based off of generally, interest rate, but it's typically some sort of premium that you'll put on top of whatever the risk-free rate in the market is to value the property, and it's based off of the net operating income of the property. So, like you mentioned, in this higher interest rate environment, cap rates, which is the net operating income as a percentage of the company to be a larger percentage of the value of the property to be a larger percentage. So what would you recommend as a limited partner, someone who's looking to get involved in the real estate space, looking to invest in the real estate space? What are some questions, some red flags they should look out for when they see opportunities? Is it just people stretching numbers to make it work? Is it just people underestimating the cost of expenses? What do you recommend for someone looking to invest in real estate?
For sure. So real estate seems super complicated, and there's definitely a lot of complicated components to it. But I think you could break real estate down into three things, right? You have the market that it's in, you have the person that's operating it, and you have the financials or property operations and T12 rent roll type how net operating income side of the property.
Mm-hmm.
So from the sponsorship side, know who you're investing with, right? That is probably the most important thing in any investment you do across any industry. Who is taking your money and using it? Do you trust them? What are the fees like? And do you think they're someone who, will make you money and knows what they're doing? What's their experience level? Then you have the market. Do a little bit of research. A lot of the market trends are public data. You can, pay for it with a CoStar or Reis, and they'll kind of break it down for the real estate components. But, know the area that you're investing in, and look online and find out what's the demographics like. What's the employment strength. What are people's average median income in the area? Are there a ton of cranes up? Are people building a ton of multifamily assets right there? And is it too much where you think your occupancy might get affected, or is it like a good amount where it's a driver and all of a sudden people are going to move into that area? What's the school systems in the area? What are single family houses going for in the area? One thing that we've seen across the last 3 years that I think has been the leading factor in the rental growth in a lot of these multifamily spaces was both the single family homes skyrocketing, where people are just priced out and can't afford it, and then the cost of construction. It's not necessarily at the all-time highs that it was during COVID when we had the shipping constraints, but we're seeing construction for new buildings get to a point where you can't build a new building and rent anywhere near where the bottom of the market is right now. And so over time, there's no competition. It used to be, you raise your rents too high, someone builds for cheaper and they get an incredible return. That doesn't exist anymore. So those kind of class C and C minus assets that, used to be the bottom of the market, they're slowly able to just raise their rents a little bit, and there's no competition coming in telling them that they can't.
Wow, it's a great point. Because you talk about inflation and construction costs and the replacement value of these properties. Like you mentioned, there was always the idea that someone could just build a new one and they could charge more of a premium on their rents. But what's interesting is that in this market, yes, we don't have the supply chain issues that we might have had during peak COVID, but there are a lot of other issues that are out there that have been making challenging supply chain, costs go up, workers having trouble finding the right labor costs. So do you think it is the right time to invest in real estate when we're dealing with some continued unrest across the world and supply chain issues? I know we had those issues with the Houthis in Yemen that have caused a lot of materials actually to cost more to ship overseas to America. Is it the right time to invest in real estate when we have some of these macro issues, but also at home, a lot of the interest rate issues?
I wish I had a crystal ball and I could tell you when the best time for investing in anything was. And, the stock market, you can never predict it. I can't predict it, at least. But what they say, over time, if you invest your money every single month over the time, over the course of your life, you will make money. I think real estate's the same. Over time, assets will appreciate. I don't know if now is the perfect time to get into the market. I think it's all going to depend on the property that you're potentially investing in. But if you can find a solid cap rate right now with an operator that knows what they're doing, or you want to get in and, try operating a smaller property on your own, and you can find a good cap rate and a good market, I think it's an incredible time to buy, because I think rates are higher now than they're going to be over the majority of our lifetime. And at some point, if you can buy and make money now, once rates come down, you'll be able to, get an additional premium just by refinancing at the right time.
Mm-hmm. Yeah, it's great insight. And what would you recommend for someone who's looking to break into the industry that doesn't really know where to start? You mentioned as an investor, when you look at a deal from a passive standpoint, you got to ask some of the intuitive questions. What's the market like? How's the growth looking? What's the school system, the crime rate? But what do you recommend someone who wants to get more intimately involved into the industry, that doesn't know where to go?
I honestly think operators are super friendly with people trying to get into the industry. There's like this appreciation, and like, I want to help others. There's I did this at some point where I started from nothing, and I worked my way into the management side of things, and the operations side, and I want to help other people do the same. So I think just reach out to anybody that you know in the industry and start asking them, how did they get started? What did they do? Listen to this podcast, do things where you can start to get that baseline understanding. And there's plenty of data out there, and Reddit's a fantastic tool to do some research into ways to invest and how to get started on things. There's tons of online tools that I would highly recommend.
Mm-hmm. That's great advice. And real estate itself has a number of strategies. You could do the value add play, new construction, maybe just a buy and hold, maybe a short-term rental. Are there certain strategies that you think are going to do better in this environment versus maybe what they've done in the past?
Yeah, I think the long term hold is what's going to do what's going to make them the big money over time. I think there's still value add opportunities out there. There's definitely no denying it. They're just very active plays, right? There's a lot of bad debt we're seeing across the country, and if you can really figure out how to evict tenants, get the right tenants in, or get current tenants to start paying, and have that active management component. There's some real opportunities just by getting properties that are 80-85% collected, and getting them to their stabilized 90-95% in the areas right there. That's a huge value add. And being able to clean up a property, right? You have a property that maybe has some crime. If you can really come in, and again, it's a very active play with larger staff, and hiring security guards, and or getting officers to come live at the property, but doing things to really clean up an area, is also a real way to add value to a property. But I think we're not seeing this 2-3 year, buy, refi, and sell at a
Mhm.
huge premium. We're seeing, you got to find the right markets, and they're going to appreciate over time. But they should be long-term plays, and you'll make money on the eventual sale down the line in 10-15 years.
Mhm. Yeah, so I mean, Greystone has had a lot of success over the past many years, specifically these past really 1 to 2 years, because banks have largely been tightening their lending requirements and kind of getting themselves out of the market. A lot of the reason for that is just overall shakiness in the market, but a huge reason is because they're very sensitive to interest rates because their cost of capital is very high, whereas Greystone, who works with agencies, don't really have that challenge. Do you see that trend continuing over the next few years, where Greystone will just take over the business of a lot of these typical regional banks?
Definitely over the next year. I don't know beyond that. I think, right, once when people are making too much money, right? If the Greystones and the lenders and the Fannie Mae's and Freddie Macs and HUDs are dominating the lending market, the banks are okay with that while their cost of capital is super high, and while there's this perceived risk in the market. But if that cost of capital goes down a little bit as the Fed starts decreasing their rates, and they're seeing that the returns for these investments are really strong. I do see the banks kind of entering back into the market over time, but I do think over the next year or two, it's going to be an agency game, and they're going to be dominating the market. I don't have the exact numbers, but I think they primarily do 50 to 60% of the lending in the country between Fannie, Freddie, and HUD. And I think, it was close to somewhere between 80 and 90% this past year. And I think that trend's expected to continue
Wow.
over the next year or two.
Those are huge numbers, honestly, to think that you're talking about a multi-trillion-dollar industry and that agencies are just dominating. And
Yep.
just can you walk me through how an agency loan really works in terms of once you get an application and that process versus I know you have to send it over to the agencies to underwrite it as well. So what does that look like really from an operator standpoint from A to get to Z, and what does that loan look like after it actually closes?
Yeah, so it's a little different between Fannie, Freddie, and HUD. I'll lump Fannie and Freddie into the same category just for simplicity, but there are some differences that I'm happy to go into details with anybody if they want to reach out after after they listen to this. But Fannie and Freddie, someone would send us a deal, we would kind of soft quote it for them. And once we got their approval, we would submit it to the agencies for an official quote, and that's where they do their initial screening. And we kind of put together this 20-page packet where we're selling the deal. They look it over, they agree with us, they don't agree with us, they make some tweaks or changes, and they come back and give us a full quote for what they're willing to lend on the asset. And then we would put together an application and get started on the deal. We have an underwriter from our team who's representing Fannie or Freddie, and underwriting the deal per their guides, right? They have these 1,000-page guides that are basically the process of how you're supposed to underwrite an asset. And then we have a lot of delegation internally to kind of work through the deal as long as we're following their guides and standards. It's about a 45 to 60-day process for Fannie Mae, maybe a 60 to 75-day process for Freddie Mac to get the loan closed. I've definitely seen it a lot faster on the Fannie side. And from there, we're basically doing our full due diligence. We're on the front end. Maybe we got a T12 and a rent roll and ask the borrowers what their net worth and liquidity is. And then, once we kick the deal off, we're pulling credit reports, and we're getting, full personal financial statements and schedules of real estate, and doing like a full analysis on all the documents that we're getting, to make sure that we're following these guide requirements, and making sure that we're lending to somebody who we trust, and to an asset that we feel comfortable with.
Hmm. So through my experience on the traditional regional banking side of the standard commercial real estate loans, a big challenge was getting a quote initially and then actually getting that same loan to closing. Obviously, things fall apart. There could be issues with the borrower, issues with the asset. Do you notice that there are certain challenges that a lot of borrowers have to overcome in order to actually get their loan that they initially were quoted to the finish line? Is it third parties? Is it appraisal? Whatever it is.
Yeah, so that is something that is exactly what kind of my job is, and my team's job, right? My boss kind of built out a team where the originators and the guys kind of helping facilitate the deals with the investors are so knowledgeable in the underwriting that from the get-go, when they give terms, they're so confident in those terms, and they know the questions to ask to get ahead of any potential issues. And then as they're managing it with the underwriters down the process, they're trying to make sure that we're sticking to that commitment from the application, and getting our clients the best deal. And that's why we've retained almost all of our clients over the last few years. But at the same time, the most important thing to make sure that you don't get retraded from the application up until closing is to give all the information up front. The amount of times where
Mhm.
people have tried to hide bad debt that's going to come out, or they've sent us an old T12 when it was at the peak of its collections and the top NOI, and then the next 4 months we just see things continue to trend down and down and down. At the end of the day, the numbers are what they are, and hiding it from us is only going to make it worse down the line, where maybe we can come up with a strategy to kind of get you somewhere where you're still happy, but guarantee that you're going to be there, and make sure that we can stick to that throughout the process. Whereas, if things start to get worse after the fact, there's some different underwriting that you're supposed to do when things are declining. Without kind of understanding the story and what's going on, there's no way to really push back on that and try and help them maximize the loan for them.
Right. Honesty and integrity through and through for sure. That
Yeah.
makes sense. And I guess really just to finish up, I think it's something very interesting in this environment. So we spoke about different strategies, buy and hold, value add. You mentioned that long-term assets are where it's at. You also mentioned that sometimes when loans don't they aren't cash neutral, meaning that an existing loan does not really pencil out, say in 5 years or whatever it is they get their refinance because interest rates are higher. You mentioned that people will get a preferred equity slug investment that kind of helps the operator not have to put so much cash into the deal. What I think is fascinating in this environment is that you could see one property and you can kind of slice it up into different tranches. You can be the debt side, hard money, preferred equity. Do you see certain opportunities within the actual capital stack itself for just nice risk adjusted returns for a typical investor?
Yeah, I mean, it's hard to break into that pref equity space, and there's definitely some risk in that. And as you start getting to the top tranches, so I wouldn't recommend a newer investor to get into that space. But I mean, pref right now is 13, 14, 15% from an accrual basis. So maybe they're giving the borrowers a lot of relief by putting it at a 5, 6, 7% current pay, but over time they're getting essentially risk free. If you don't think values are going down by over 10% or 20%, if they're at an 80% LTV max on their pref slug, they're getting a guaranteed 13 to 15% with,
Right.
worst case scenario, they force the sale and get their money back. So I think there's a lot of really good opportunities out there. And that makes sense. When people get desperate and they don't want to give keys back and they want to, give their property some more time to hit its, value add plan and get to their takeout strategy, they're going to pay a little bit more to make sure that they're secure. And that means there's good opportunities for investors.
Yeah, yeah, I think it's amazing because these people are coming in and they're getting equity-like returns as if they own the whole property with,
Mm-hmm.
without having to have that risk. And then the downside for them is that they basically take over the property and they still made that return. So I think it's really interesting in the market when you have these higher interest rates that there is an opportunity to actually make these great risk-adjusted returns without as much risk as actually owning the full property.
Yep.
I think that's great insight. Well, Avi, thank you so much for your time. This has been a great discussion. Do you have any parting words, pieces of advice, thoughts that you wanted to share the crowd?
Yeah. The most important thing and the biggest trend that I've seen over the last few months has been the lender's focus on property condition. From 3 years ago to now, we have seen so much deferred maintenance and so many investors that are focusing not putting work into the property, but their capex is only interiors, it's not exteriors. And you're neglecting driveways and parking lots and roofs and these things that when you drive by a property just doesn't look like it's in good condition and potentially is over time going to deteriorate to a point where it could be a hazard. And that's just not what the lenders want to be putting their names on right now. It's not the asset type that they want to be doing. They don't want investors that are trying to take shortcuts. They want investors that are in it for the long run, that want good bones for their properties. And that has been the biggest factor for retrades or deals not moving forward or struggling on the debt side. So I would say take care of your properties. I know it costs a little bit more, but in the long run, it will 100% pay for itself. And that's how you make sure you're not on these, lists of people that aren't getting deals done, with some of these lenders.
It's great, 100%. Thank you, Avi, so much. I really appreciate the time.
Yeah, my pleasure. Take
Talk
care.
soon.